British Prime Minister Theresa May recently triggered Article 50 to begin the Brexit process. The controversial vote has sparked both political and economic uncertainty for the UK. Earlier, I spoke with David Dodwell, Executive Director of the Hong Kong APEC Trade Policy Group, and Paras Anand, Fidelity International CIO for Europe in London, about the effect it may have on trade and markets. Hi, Paras. Thanks for joining us. So, first of all, what would you say the effect of Brexit is on financial markets?
The interesting thing about Brexit was it had, with the passage of time, almost no impact on markets overall. The market where we saw a significant impact of Brexit was really on the currency market. So we saw a further devaluation of sterling, which had already been on a falling trend. And that level of sterling has sort of maintained since we've been in the sort of the period post-Brexit.
Do you think it's going to maintain the level where it's at now? And if so, is this a good level for it to stay at?
When you kind of look at it on a kind of a long-term sort of purchasing power parity perspective, I think sterling looks quite competitively priced. So I think that the combination of the fact that the economy's performing better, sterling is at a competitive level, and actually the outlook for policy rates is likely to be on the upside rather than sort of cutting at this point. I think that suggests that sort of sterling is well supported.
David, what do you think about this? Do you think that sterling is at a good level? There are other things to consider.
I think the caveat is really that we have not yet got a clock that's ticking, or it has only just started ticking. None of the practical consequences are going to materialize, at least for 2 years, and perhaps for 4, 5, 6 years. And that's allowed most people in business to say, okay, we've got some time to think about this, we've got time to lobby, we've got time to argue our corner for our sector, and I think that's introduced some calm.
You talk about the 2-year period. During that time, we'll have elections in Europe, we might have rate rises, and of course the negotiations. How do you think that might impact the economy and impact trade?
From a British point of view, we've tended to look at Brexit as a British event, but as a European event, it's extremely significant. It's very real to say that the European project is at the very least going to need to be redefined, and it could be in trouble.
Paras, what do you think about that? Do you think that the markets are going to be affected by this period of negotiation, by the elections, by rate rises, and if so, in what way?
Business just operates at a different metabolic rate. So for us as investors, when we think about what is going to be the drivers of the market, the drivers of individual stocks, we shouldn't be distracted too much by what's happening in the broader political environment, but remember to sort of focus on what's happening at the individual sort of company level.
So in this case, as an investor, would you really be looking at value stocks? And do you think maybe in the equities market, especially in the UK, that some of these might be undervalued?
The market in general becomes very sort of short-term focus. So you might have a business that has very strong long-term prospects, but because it's, let's say, very exposed to the UK domestic economy, people are nervous about Brexit, the valuation gets taken down.
Do you think we're going to see companies maybe that manufacture everyday goods? Are those going to see some rough times?
I think a category that I would be particularly sort of, mindful of is businesses that really don't have a degree of pricing power. One of the things that we may need to contend with is the possibility of inflation, and if you don't have that pricing power, you don't have the sort of the market presence, you don't have the strength of franchise, and actually the impact of that inflation is something that's kind of negative, for margins. We're also seeing across Europe and most developed markets as well, in that context, a degree of real wage inflation that we haven't seen in the last sort of few years.
How do you think people should be managing their portfolios? Should we be very concerned about what's happening in politics?
I think if we are starting to see inflation, returning and to sort of more normalized levels, then it represents a risk around simply sort of holding all of your investments in the context of sort of fixed income instruments, because you still risk the sort of the degradation of the purchasing power of your money, as you go sort of forward in time. I think that equities represent a good long-term allocation for investors in combination with bonds. So potentially in that context, people should be prepared to take a more balanced view. So rather than just a purely sort of cautious view.
The UK is going to have to negotiate their own trade deals in maybe 2 years' time. What are some of the issues you see that they might be coming up against?
It is interesting how the May government has started travelling the world, selling bilateral trade agreements, of course, before they can actually start negotiating them. That's counterproductive in a number of ways.
Right.
So we need multilateral agreements, we need plurilateral ones. From that point of view, the European economy is a much more rational economic unit around which you can disperse your business activity than a single isolated economy.
You think realistically they could probably manage plurilateral trade deals, and if they're lucky, a multilateral trade deal?
Multilateral are outside their power, but there are plurilateral arrangements available. And of course, the most significant one in this whole discussion is Britain's future plurilateral relationship with Europe, right?
Of course.
It's the 27 economies, but they ought to be targeting other multi-country groupings, all very, very big countries. So ASEAN as a 10 economy grouping would make some sense. China and the US and so on as big economies justify attention. But beavering out here to Hong Kong to forge some a bilateral trade deal with a city of 7 million people is a very poor use of manpower. The UK, for the last 35 years, has forfeited its trade negotiating authority to Brussels. All the expertise sits in Brussels. I think the UK has about 20 to 25 people who have the expertise to deal with a negotiation of or drafting of trade agreements. So even if we set about plurilateral deals, we still don't have many people around to do it yet.
Just to put it into context, you say the UK has maybe 20-25 people qualified to do trade negotiations. What does the EU have? What does the US have?
They have hundreds. Hundreds and hundreds. And nowadays, trade agreements are no longer simply at the border tariff discussions over whether a tariff can be cut from 20% to 5% to 0%, whatever. It's behind the border, it's regulations, it's licensing, there's a very wide range of quite technical issues that require expertise across a very broad range. So this has gone well beyond the remit of trade officials.
Thank you so much for your insights, both of you. Thanks, Paras, and thank you, David.
Pleasure.